Now, if you've paid any attention to real estate investing whatsoever, and unless you've been living under a rock, you probably have already heard of a DSCR loan. Well, let's talk about what it is, how do you get one, and is it really appropriate for your portfolio? First of all, most investors want to start off with a conventional loan. You know, the type of loan that you go to the bank or you go to your mortgage broker and you get for your primary residence, for instance. You know, Fannie Mae, Freddie Mac, all that fun stuff. But that comes with problems. So first of all, it uses something called debt to income ratio. Now, this isn't the DSCR loan. This is the conventional loan. The debt to income ratio compares your income and your expenses. In other words, it puts the expenses on the top, your mortgage payment, your taxes, your insurance, your car payment, student loan payments, credit card payments, all that fun stuff. That goes on the top of the equation. They divide it by all of your income. So they're going to look at all of your income, like you're going to get your tax returns from your businesses. They're going to look at your W-2s, your pay stubs, the whole thing. And they're going to compare all that stuff lumped into one. So it's really a full documentation type of loan. And here's where it kind of gets a little bit scary. That let's talk about how the debt to income is actually calculated. Now, Fannie Mae, Freddie Mac really only wants you to have maybe 43 to 50% max. It says 43, but they'll go up a lot higher than that. Meaning, if you take all of your expenses, divide it by all of your income, really needs to be 43% or less. That's kind of the focus. 50 on the out, on the top end. But let's do an example to kind of illustrate my point of why it's really difficult to scale with a conventional loan. So let's say you make $4,500 a month, and let's say your total payments, mortgage, taxes, insurance, car payments, all that fun stuff, that's $2,000 a month. All right. So if you divide 2,000 by 4,500, you get a 44% debt to income ratio. And that's something that you can usually get done. Not a problem there. But let's say that you go out and you find a fantastic rental property that's bringing in $1,900 a month of rent, and it's only going to cost you an extra, say, $1,600 in expenses, meaning principal, interest, taxes, insurance, HOA on the new property. So you're positively cash flowing $300. But let's see how Fannie Mae and Freddie Mac are going to look at that with a conventional loan. First of all, they're going to take the $2,000 in expenses that you already have. They're going to add on the new $1,600 in expenses for a total of $3,600. But then they're going to look at also the income that's coming in. So they're going to take your current $4,500 plus the new $1,900. And lo and behold, your debt to income just jumped from 44% to 56%. I know it's crazy, but that's how Freddie Mac and Fannie Mae take a look at it. And you would normally no longer qualify on something like that. So that's the problem with conventional financing and trying to build and scale a rental portfolio. You might be able to do one, maybe two new properties, but once you get beyond that, debt to income ratios just don't work. And that's why the DSCR product was really born, so to speak, because it doesn't look at your whole income and all of your expenses. It only looks at the property itself. So we're only going to look at the expenses from the property, namely the principal, interest, taxes, insurance, and the HOA on the new property, not the rest of your stuff, just that new property. And they're going to also look at the income that comes off of that. And we're going to figure out how that's derived here in just a moment. But we're going to use a different calculation from debt to income ratio, which normally the lower is better. But we're going to go to something totally different, which commercial lenders use, which is called debt service coverage ratio. It simply is the inverse. It's the income from the property divided by the expenses. And the higher, the better. The income is higher than the expenses. So when you do that math problem, it's 1.0 or higher. We'll talk about that in just a moment. So what are the disadvantages of a DSCR over conventional financing? Well, number one, the rate's a bit higher. It's been my experience. It's anywhere from maybe 1.25 points above what conventional rates are. You must also own a home currently. Now, here's where this is why this is. I know this sounds stupid, but hear me out on this. So the CFPB, the regulatory body that oversees lending and banks and things like that, the CFPB wants fairness out there. And they said back when Dodd-Frank was passed back in 2010 that lenders must no longer do these no income verification loans. Now, there are a couple out there still, but they get special treatment and there's special rules behind them. But they don't want people buying properties that just can't afford them to live in. So they've required all lenders have to double check and make sure that the income and the property actually cash flows for the customer. So since this, however, falls into a loophole, since it's not technically a consumer product, it's a commercial product, it's you purchasing it in your LLC or sometimes in your own name for business purposes, meaning for rental purposes, they allow that loophole so that they don't have to look at your entire income. But here was what was happening. Was people were saying, gee, I don't qualify for this home that I'd like to buy, so I'm just going to call it a rental property and I'm going to buy it as a rental and then move into it. Well, the CFPB got smart on that, and they went to all of the lenders and said, listen, we're going to watch you closely on this stuff. And they don't believe that if you don't currently own a home that you're going to be buying rental property. So that rule was put in after the DSCR started to get abused a little bit. So that's why you have to own a property currently. And it's pretty much with every program out there. Now, experience becomes a factor. Now, some places will allow you to buy your first rental property on a DSCR loan and not bat an eye, but a lot of the lenders now are realizing that investors make most of their mistakes early on in the process, when they start their portfolios, because they just don't have the experience level. So almost all lenders now require a schedule of experience, kind of like they want to see what properties you've owned in the past and how you've performed. So don't be surprised if you got to fill that out. We're going to talk about that in just a little bit. Now, most lenders also like to lend to entities. Here again, they're trying to establish that it is a commercial loan. So there are some lenders that have come along that have said, and usually they're more conventional style lenders that are just kind of foraying into the or the DSCR product. But those people are saying, hey, listen, we'll let you buy it in your name, but it better darn well be an investment property. And they're going to check very closely on that. Most lenders, however, require that you're buying it in the form of an LLC or an S Corp or an entity such as that. Fewer lenders are also doing these things. So you can't just walk into any bank and say, I want a DSCR loan. It doesn't happen. You usually have to go to maybe a mortgage broker like we are and, talk to them about the different options that they may have. And I will tell you, most mortgage brokers that don't have a commercial back sometimes struggle with this product. They say, oh, yeah, I can do it. Not a big deal. But the intricacies and the ins and outs of the product sometimes can get a little bit difficult. And fewer lenders are actually good at them at all. Now, commercial lenders have been using the debt service coverage ratio for years on all kinds of property, industrial property, doctor's offices, you name it. But the thing is that this is really a stripped down version of what banks do. Banks will throw in like management fees and repair fees and reserves and things like that. The DSCR lenders of today don't care about that for investment property. They're only looking at principal, interest of the payment, the taxes, the insurance, and the HOA on the property. That's all they care about as far as the expenses. And then they're also only looking at the rent. So it's a much stripped down version than what maybe you're used to with banks. Now, how do we determine the income from the property itself? Well, sometimes you can cough up a lease, but in most instances that I know, when you purchase a property, maybe you haven't leased it yet, or maybe that lease is way undervalued. So how do we do it? So the regular appraisal that you're used to seeing on just a normal appraisal for a property is called a 1004. It's a Fannie Mae form, 1004. So if you look at the very bottom corner, it's gonna have the numbers 1004 in there. That's the form. We're gonna add to it though something called a 1007. I don't ask me why we call them 10 whatevers. It's just the way that the industry has went. But a 1007 is actually just a form that's added to the appraisal where the appraiser goes in and says, hey, I'm looking at market rents in the neighborhood, and if I were to rent this property, I think this is the value that it would derive. Now, almost all of your DSCR lenders will use whatever the appraiser says is the value of that property, or I should say the value of that rent. They're going to put that in the income section, period. End of story. Different lenders have different rules around maybe if it's already leased, or maybe sometimes they'll put a vacancy factor in there, meaning they'll only figure maybe 90% of it or whatever. Different lenders have different rules, but almost all of them are going to use that 1007 figure that the appraiser comes up with as the income. When you're valuing a property, they still look at the sales approach, meaning they still say, hey, this property, I'm looking at different sales in the neighborhood of similar properties and what they went for as a value. But you also add what's called the income approach, meaning we're going to look and see DSCR really is focused heavily on income as much as it is the value. So we're going to be looking at that rental amount that they apply towards the rent as well. Now, I've already mentioned earlier that lenders really like to see an entity as a borrower, with a few exceptions. Sometimes they will allow you to purchase in your personal name. But what are the things that you're going to need if you're going to start up an entity you're going to provide to a lender to be able to get you qualified, so to speak? Now, we do a video on this as well. So be looking at setting up an LLC for kind of what you need as far as a commercial loan is concerned. So I'll leave that for another video, but you need your articles of organization. You need your certificate of standing, which kind of are gathered together when you form your LLC. You need an IRS SS4 form, which shows it's very simple to do. You can get it on irs.gov. It's really the letter that establishes your tax ID number, your EIN number for the business. The operating agreement and bylaws, it's probably the most difficult and the one thing that you may want to go to an attorney to be able to have them prepare. And also, the entity is the borrower, okay? So if you go to buy your own house, you're the borrower. In a DSCR transaction, or at least most of them, the entity, XYZ LLC, that you set up is the borrower. The owners of that entity are what are called guarantors because they are personally guaranteeing it. If the entity doesn't pay, they're going to come after you as the guarantor. So most lenders also like to see a personal financial statement from each and every guarantor that own a certain percentage. So that varies from lender to lender as well. Did you know the three most important things in lending are ability, ability, and ability? In other words, can the person pay the loan back? So how do we determine as lenders how you're going to pay it back? These are things that you're going to have to gather and think about and why we need them in order to process your DSCR type loan. First of all, we want to make sure that you've got enough funds for the down payment, the closing costs, and reserves. So we're going to ask for 2 to 3 months worth of bank statements. Sometimes you can go and get that money from, a relative or whatever, but I will tell you, banks do not like to see borrowed funds, and that's kind of a fallacy. I know there's a couple of websites out there that, you can go and borrow it, particularly on those sub-2 deals that they're doing now. Lenders absolutely hate that, and that's not something that's normal. That's just something that some of these internet people that are trying to sell courses are trying to convince you of. But most lenders do not like to see borrowed funds. Now, here's a new thing that's coming about. If you're using business funds in order to fund this DSCR type of loan, the downstroke and whatnot, they always like to see, and they think this is really stupid, they want to see a CPA letter, a letter from your CPA stating that by using these funds, it's not going to harm your business. I think it's stupid, but a lot of these funds that actually back these lenders that make these types of loans, they're wanting to see that. We've already talked about the personal financial statement, which is simply kind of like a personal balance sheet, so to speak, from each of the guarantors. We also want to see the confirmation of your earnest money deposit. So once you go under contract to buy the property, we need to get some verification, the canceled check. We need to get the letter from the title company or the closing agent that states that you actually deposited those funds. We're going to ask for those. Something else that's very, very important that almost all lenders are wanting to see are mortgage histories on all of the mortgages that you currently have. So not only including your house or other rental properties, but you want to get a mortgage statement, the most recent mortgage statement on each and every one of those. And I know this is stupid. It's almost overkill, but they want to see the tax bills, the insurance that you're carrying on other properties that have nothing to do with this transaction. Why? Well, they're nosy. That's why. But I will tell you, almost every lender requires it, so you may as well gather it up front, make it a little bit easier. And then lastly, and some lenders don't want this, some lenders never ask for it, but some do, which are meeting minutes. Meaning if you've created XYZ LLC to do the transaction or to buy your rental properties in, they want to see a meeting, and you might be the only person that owns the LLC, but they want to create meeting minutes stating that you are authorized to do this transaction that you're contemplating doing. So I know it's stupid. It ticks boxes, so to speak. Now, we talked about experience, and I'm going to tell you, I didn't do my first investment property personally until I'd probably been doing lending for 15 to 20 years. And I'd done scores of these types of loans for people. And I thought I knew everything. But I'll tell you, I made several mistakes in the first 7 or 8 deals that I did personally. So lenders are wise to that, and they want to see some experience typically for investors that are going on, and particularly if they're not putting down a lot of money on these deals. Usually, DSCR loans, at least as of the beginning of 2024, they're looking for at least, say, 25% down. You could do them for as little as 15%, but the rates are a lot higher. So, minimum 20, preferably 25 or even more that you put down. The more you put down, the more they're going to let things slide a little bit on experience, but it's going to get easier and easier as time goes on. So you're going to want to prepare what's called a schedule of experience, meaning the properties that you've done, the property address, how much you bought it for, what do you owe against it, did you rent it, did you sell it, did you flip it, what was the outcome. So they want to see that you kind of know what you're doing. All right. Very, 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 very important. So finally, let's talk about some of the information that we as lenders are going to ask for as part of the transaction itself. Okay, obviously the purchase contract. So once you get the purchase contract, make sure you get that over to your lender right away. It's going to have information that they need to start going to work on right away in order to get this all done. But something you really want to think about even before you might sign the contract, reach out to your insurance agent, your homeowner's insurance agent, and maybe even your realtor can, or even your lender can maybe refer you somebody that's really, really good, and get insurance quotes. Now, I'm in Florida. In Florida, we have this weird phenomenon called hurricanes. And whenever there's a named storm, meaning Hurricane Joe, that's coming through and it's in what we call the box, meaning it's kind of threatening Florida, all the insurance companies quit writing and binding policies. So you can't close until you actually get a binder. And if insurance companies won't bind during hurricane season because there's a named storm out there, that's your own fault. You need to start right away when you sign. Other areas of the country have their own little things that they have to deal with. But I'm telling you, you're going to want to get your insurance binder right away. Plus, you need to understand whether or not it's going to cash flow, because insurance has gone way, way up in a lot of areas of the country, particularly where I'm at in Florida because of the hurricanes. Insurance has shot through the roof, and it's become such a huge part of the rental cash flow equation that you got to make sure you can actually, that this property is going to cash flow. So I would get that right out of the gate, get at least a quote of what it's going to cost you to be able to do this. And then another big thing that people ignore, and realtors miss this all the time, are taxes. Now I'm going to use Florida here again because that's where I'm based as an example. Now, let's say that somebody in the state of Florida, taxes for a primary residence can only go up 3% a year. That's not the case with rental properties and non-owner occupied properties. They can go up as really as, a great deal more than that. But what happens is, let's say that your seller bought the property 30 years ago and they're paying just exorbitantly low taxes. So what's going to happen is, once you purchase that property, you might in that first year pay what they paid last year in taxes, but the tax assessor is going to come in and they're going to reassess that based on, hey, you paid 10 times more than what the previous guy did. We're going to jack your taxes up. And that happens all the time. So you might go from something that's very affordable to something you can't afford at all. Taxes have become, along with insurance and interest rates, just a killer of cash flowing rental properties. So a lot of the county property appraisers in the state of Florida, and I know around the country, will do what's called a tax estimator, usually on their website. You plug in the address, plug in how much you're going to pay for the property, and it'll estimate a kind of a range of what the taxes may jump to. Your real estate agent can probably help you with that as well, but make sure you think of that. Don't just go off of what the taxes currently are, because that person may have had the property for a long period of time, and they're probably grandfathered into an older tax rate, so to speak. So anyway, that's kind of the synopsis of the DSCR type loan. It's great for scaling. It is going to be a little more expensive, but it's a little more forgiving to be able to qualify for. Now, if you have any questions, certainly place them in the comments below. Why don't you just shoot me a message? Happy to answer any questions that you may have about the DSCR type loan. I hope you found this valuable. Have a great day.